Warren Buffett is worth over $141 billion, but what's fascinating isn't what he does, it's what he never does. So these three moves he avoids have helped him beat the market consistently over 50 years, turning everyday investors into millionaires. And in 1969, when others called him crazy for doing the opposite of Wall Street, he proved them all wrong. But here's what's really interesting. While flashy hedge funds with their complex strategies lose money, Buffett's boring approach generated him over 3.6 million% since 1965. Yes, you heard that right, over 3 million%. Meanwhile, the S&P 500 returned just over 30,000% in the same period. Now, before we dive into these three moves, let me share something most people don't know about Buffett's early days. And pay attention here because these numbers are pretty mind-blowing. In 1956, Buffett started with just $105,000 in investments from friends and family. Through these principles of what not to do, by 1969, he had turned it into $104 million. That's a return of almost 30% per year, beating the market by 4x. And get this, in 2008, Buffett made a famous $1 million bet. He wagered that a simple S&P 500 index fund would outperform a carefully selected group of hedge funds over 10 years, and Wall Street laughed. But by 2017, Buffett's index fund returned 85.4%, while the hedge fund managed to only get 22%. I studied every interview, shareholder letter, and meeting transcripts to uncover the three moves that he religiously avoids. And what's surprising isn't what these moves are, but how they go against everything that Wall Street tells you to do. So I'm going to break down each one of these moves, and I want you to pay special attention to the first one because it's probably not what you're expecting. In fact, it's the complete opposite of what most successful investors preach. The first move that Buffett never makes is investing into businesses that he doesn't deeply understand. Now, this sounds obvious, right? But here's what makes it profound, and you're going to want to follow closely here because this is really interesting. Think back to 1999. The internet was exploding. Companies like Qualcomm were up 2,600% in just 1 year. Now, everyone was making millions in tech stocks. I mean everyone. Your taxi driver had stock tips, your barber was day trading, and CNBC was calling it the new era where old valuation rules didn't matter anymore. Now, here's where it gets fascinating. Buffett's friends, including Bill Gates himself, were urging him to invest into technology companies. Now, let me share a conversation that perfectly illustrates Buffett's thinking. Gates visited Buffett and insisted that he needed a computer. So picture this, the world's richest man trying to convince the world's greatest investor to buy a computer. The conversation went something like this. Buffett asked why. Gates said, well, you can do your income taxes on it. And then Buffett replied, well, I don't have any income. Berkshire doesn't pay dividends. And then Gates tried again, well, you can keep track of your portfolio. And then Buffett smiled and said, well, I only have one stock. When Gates argued computers would change everything, Buffett asked something seemingly simple but profound. Will it change whether people chew gum? Gates, of course, said no. Well, will it change what kind of gum they chew? And again, no. Buffett concluded, well, then I'm going to stick to chewing gum and you stick to computers. Now, here's where the story gets really interesting. While others lost fortunes when the dot-com bubble burst, we're talking about trillions of dollars in market value just completely wiped, Buffett's portfolio remained stable. But here's what most people miss about this story. It wasn't about avoiding tech specifically, it was about avoiding anything that he can fundamentally understand and value. Let me put this into perspective with some numbers that might surprise you. From 2000 to 2002, the Nasdaq fell 78%. Companies like Pets.com, Webvan, and Boo.com went bankrupt. Meanwhile, Berkshire Hathaway's per share book value increased by 28%. And there's this dramatic difference because while others were pouring money into businesses they didn't understand, Buffett was heavily invested into companies like Coca-Cola, American Express, and See's Candies. Businesses with simple, understandable models and predictable cash flows with strong competitive advantages. He knew exactly how they made money, how they would continue making money, and most importantly, what could go wrong. This deep understanding meant that he could sleep soundly even when the market was in chaos. And that's the power of never investing into something that you don't understand. It's not just about avoiding losses, it's about having the confidence to hold steady when everyone else is panicking. But understanding businesses wasn't enough. Buffett's second never go-to move is equally important, and this one goes against human nature itself. In fact, it's so counterintuitive that most investors struggle to accept it, let alone practice it. The second move that Buffett never makes is trading based on market timing or price movements. And this is where things get really interesting. He tells a story about Mr. Market, which he learned from his mentor, Benjamin Graham. Now, I want you to really visualize this because it's a powerful way to think about the stock market. Imagine you own a business worth $100,000. Every single day, someone named Mr. Market comes to your door. But here's the thing about Mr. Market. He's emotionally unstable. Some days he's so excited that he offers you $200,000. Other days, he's so depressed that he only offers you $50,000. So here's a $1 million question. Would you sell just because someone offers you a lower price? Or would you buy just because the price went up? Of course not. Yeah, this is exactly what most investors do in the stock market. They buy when prices are high because everyone's excited, and then they sell when prices are low because everyone's scared. Let me show you how powerful this principle is with a real example from the 2008 financial crisis. When everyone was panicking and selling bank stocks, Buffett invested $5 billion into Goldman Sachs. People thought he was crazy. The financial system was collapsing, but here's what happened. The investment netted Berkshire Hathaway over $3.7 billion in profit. And the reason is Buffett wasn't trying to time the market. He understood Goldman Sachs' business value regardless of what the market was doing. And here's something fascinating. Buffett explains it with a simple phrase. The stock doesn't know you own it. Think about that for a second. While others are checking their phones every 5 minutes, obsessing over price charts and technical analysis, Buffett focuses on one thing, the actual value of the business. Let me share you some numbers that might shock you. A study showed from 1994 to 2016, the average retail investor earned just 2.6% in annual returns, while the S&P 500 returned 10.2%. And the reason is because they were trying to time the market, jumping in and out based on prices rather than value. Now we're going to get to what I consider the most powerful of Buffett's never-do moves. And I want you to pay extra close attention here because what I'm about to explain goes against everything modern investment culture preaches about getting in early and buying the dip. The third move that Buffett never makes is investing without a margin of safety. Now, before I explain this concept, let me share one of Buffett's most powerful analogies that will make this crystal clear. He puts it this way: if you're driving a 9,800-pound truck and see a bridge with a weight limit of 10,000 pounds, do you cross it? Most people would say yes because you have a 200-pound margin, but Buffett would drive further to find another bridge. In investing, most people do the equivalent of not just crossing the bridge, but adding more weight to their truck while they're at it. Let me show you what I mean. Think about crypto investors in 2021. When Bitcoin was at $60,000, people were taking out loans to buy more. They had no margin of safety, and when it dropped to $30,000, they were completely wiped out. But here's the thing: Buffett has been using this principle to avoid catastrophic losses for over 60 years. Let me give you a real example that shows just how powerful this approach is. In 2016, Buffett started buying Apple stock. But here's what's really fascinating: Apple wasn't some unknown company. It was already one of the world's most valuable businesses. So why did he wait until then? It's because he wasn't looking for a good price. He was waiting for a price so good that even if things went wrong, he'd still be okay. And look what happened. That investment has made him over $100 billion in profit. Let me break this down into something that's practical that you can use. Here's how Buffett thinks about margin of safety. If you think a stock is worth $100, don't buy at $95 thinking that you're going to get a deal. Wait until it's $70 or less. This patience has protected Buffett through multiple market crashes and economic crises. And here's something that might surprise you. Buffett often holds billions of dollars in cash, sometimes for years, waiting for the right opportunity with enough margin of safety. In 2004, he held $43 billion in cash. Wall Street called him outdated, but when the 2008 financial crisis hit, guess who had the cash to buy amazing companies at fire sale prices? Now let's connect these three moves because they work together in a fascinating way. Now I want you to really think about this because it's probably the most important part of this entire video. When you never invest into businesses you don't understand, never try to time the market, and never invest in without a margin of safety, something incredible happens. You start making decisions like Buffett. Let me show you how powerful this combination is. From 1965 to 2021, the average hedge fund returned about 10% annually. The S&P 500 returned about 10.5% annually, and Buffett's Berkshire Hathaway 20.1% annually. Now those numbers might not sound that different, but here's the mind-blowing part. Because of compound interest, that extra 9.6% per year meant that Berkshire grew by over 3.6 million % over that period, while the S&P 500 grew just over 30,000%. Now you might be thinking, okay, that's great for Warren Buffett, but how do I actually put this into practice? Do I have to wait for another financial crisis to make money? And the answer is absolutely not. Let me show you how to apply these principles in today's market. First, you have to understand the business. In 2025, this might mean looking at companies you interact with daily. Take Visa or MasterCard, for example. Every single time that you tap your card, they make money. Or Apple. They have an ecosystem of products that keeps customers locked in. And these are businesses with models they can understand just by being a consumer. Now, understanding doesn't mean you have to stick to old economy stocks. For example, if you work in artificial intelligence, you might have a deep understanding of which AI companies have real competitive advantages versus those that are just riding the hype. That's your circle of competence. Second, about market timing, instead of trying to predict where the market is heading, set up automatic monthly investments. When prices drop, you're buying more shares, and when they rise, you're buying fewer. This is exactly what Buffett recommends for most investors. And for margin of safety, here's a practical approach. Instead of trying to buy at the absolute bottom, look for companies with strong balance sheets, lots of cash, little debt, and also consistent cash flow. Even in today's market, there are companies trading at reasonable valuations if you look beyond the headlines. Let me give you a concrete example. Many investors in 2024 were piling into the Magnificent Seven stocks at any price. A Buffett-style approach will look like this. First, pick the ones that you truly understand. Number two, wait patiently for market overreactions or corrections. And number three, only buy when there's a significant margin between price and value. The key is this: you don't need to wait for a massive crash to apply these principles. You just need to be more selective and patient than the average investor. These three moves Buffett never makes aren't complex. They don't require an MBA or sophisticated trading software, but they do require something that most investors lack, and that's discipline. As Buffett says, the stock market is designed to transfer money from the active to the patient. And that's really what these principles are about, having the discipline to do these things. Number one, never invest into what you don't understand. Number two, never trade based on market movements alone. And number three, never invest without a margin of safety. I mean, really think about it. While others race to invest into every new trend without proper research or understanding, Buffett stays focused on what he knows best. He's not against innovation or new technologies. He's against investing into things he personally can value with confidence. That's an important distinction. And this disciplined approach has kept him as one of the richest people in the world through every market cycle, every new technology wave, and every paradigm shift in the economy. So here's my challenge to you. Next time you're about to make an investment, whether it's stocks, real estate, crypto, or anything else, ask yourself these things. Do I truly understand what I'm investing in? Am I just buying based on price movements or fundamental value? And do I have enough margin of safety? Your answers to these questions might completely change your investment approach. If you found this video helpful, hit that subscribe button for more insights on building long-term wealth, and also like this video for more feature content. And also let me know in the comments which of these three moves surprised you the most. I read every single comment and I'm curious to hear your thoughts. Thanks for watching, and I'll see you in the next video.